What if I told you that despite what you've heard, there are some niche opportunities where whole life insurance makes sense? Keep listening as we dive in. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you had learned in medical school. I'm your host, Justin Harvey, and here is your co-host who is celebrating his 15th wedding anniversary the week after this show is published, Dr. Jimmy Turner.
Yeah, this is a pretty cool milestone for us, and Kristen and I are excited. We're actually going to go on a trip to the Dominican. We've been there once before, and we actually we loved it. And the water there is just gorgeous. Have you been to the Dominican, Justin?
I haven't. I've been to Grand Cayman, which was awesome, and that's my only jaunt to the Caribbean up to this point.
Yeah, no, it was great. And the way that we pulled this off, it's actually like probably a $13,000 trip. And which I'm not opposed to people spending money on trips, particularly. I mean, this is a 15th anniversary. We wanted to do it right. But the way that we actually pulled this off, Kristen, I look at my credit card, stuff like we get the balances. We're still old school. We get the paper copy sent to our address. And so we look into that. And but I don't log on to Kristen's online portal very often. And so I knew in my Amex account, I had about 100,000 points, give or take. And I opened Kristen's and she has 400,000 points because we've never used them. And she's used that card for God knows how long. And so we basically got this trip for free after we looked into my point situation, her point situation, and learned the little hack that you actually shouldn't book things directly through Chase or Amex. You should transfer it to one of their partners and then use it there because the points go further. And so, yeah, we're really stoked about this trip, and it's my first legitimate credit card hacking job that I've done, and it was absolutely completely unintentional.
Let me tell you about a credit card reverse hack, meaning something that you do accidentally that you actually don't want to do. That happened to me when I was trying to do this. And I was like, oh yeah, transfer to the third party partner. You don't go direct, you go to, I'll move everything to World of Hyatt. And I, book Hyatt, whatever. And I accidentally transferred 250,000 points to Hyatt instead of the 2,500 or 25, I forget what it was exactly at the time, but I ended up making this irrevocable, moving my points in a way that I couldn't get them back to Chase. And that was, now I still have 300,000 Hyatt points that I don't travel that much, and I definitely don't stay at Hyatt that much. So I'll be carrying those for a while, which is a huge bummer. So don't do that.
I think we actually didn't use World of Hyatt. I'm glad I didn't click on the wrong one.
Yeah.
There is some irony in this trip though, is because it's an all-inclusive. And I recently stopped drinking, I think for good. And so I think the resort's going to save a little bit more money on me. So maybe I didn't get the full credit of my 400,000 points that I used for this all-inclusive resort where I'm not going to drink any alcohol. But we're super, super excited about this. So this show, I actually think that we're going to take an interesting take, Justin, because a lot of people who listen to this podcast listen to other podcasts in the physician finance space. And we're constantly told that whole life insurance is a terrible financial product, that no physician in anywhere, in any circumstance should ever use this. And that if you are, you've been swindled, you've been taken advantage of, this is the worst possible product in the world. And I'm excited to dive into this and have a more nuanced view, because I view whole life insurance a little bit about, how I view politics. Things are just too polarized, they're too black and white. And there is nuance, there is gray, there is a place for this product to exist. And we're going to dive into that show. But before we do, don't forget, if you need help with student loans, disability insurance, you want to download a free copy of the Physician Philosopher's Guide to Personal Finance, completely free. We can help you with all of that at moneymeetsmedicine.com, where we focus on financial literacy, disability insurance, student loans, and career coaching. Can help you with all of those there. So, Justin, let's dive into this, right? So I think let's just start high level, because I'm going to punt this to you a lot because you have more experience in handling these things than I do. But when to consider life insurance, just from a financial literacy standpoint, right? This is when you have somebody who's dependent upon your income. That can look different for different people. That might mean your spouse or your partner. That might mean children. It might mean, your parent that is dependent upon your income. If someone is dependent upon your income, and if you were to die and they would need to be supported, that is when you'd consider life insurance. And when it comes down to that, a lot of people don't realize that permanent insurance, which is what whole life is a kind of permanent insurance, was all that used to exist. Historically, that is just what was offered back in the day. Term life insurance, which is oftentimes the best option for many doctors, came along later. And so real high level, term life insurance, you get paid, you die, right? It has a term. So it might be to age 65, it might be to 80, but either way, you die, you get the benefit stated in that policy. That's it. Permanent life insurance, which there are lots of different kinds: whole life, universal life, variable life. They have different features, different product marketing that happens with each of these things. They offer that death benefit, but then they also offer cash value. And I think it's illegal, as far last time I checked, to call that an investment, but it's definitely how it's spoken about when you talk to an insurance agent trying to sell you whole life insurance, is that it is a death benefit plus something that grows in the market that we're not allowed to call an investment for some reason. So real high level, Justin, am I getting that right so far?
Yeah. One thing that I would mention just for our listeners, because this is an important point that I think gets overlooked, is term life is awesome. It's super, homogenous. Like the products are pretty similar between carriers by and large. And if you make a lot of money, insuring your family for that income is really important. In addition, insuring your spouse, even if they stay at home, there's significant economic benefit in someone staying home with kids if you do have kids. And so insuring non-working spouses also makes sense with term coverage of often, $1 million or $2 million, because, there's studies that estimate the economic value of a stay-at-home spouse somewhere between 150 and 180 grand per year, depending on your life and how it all works. So act like your stay-at-home spouse makes 180 grand a year when you're thinking about how much they should be insured for. There's also opportunity cost of you not working your full-time high-paying job or trimming to half-time while you hang out with your kids in the aftermath and trauma of losing their parent. So certainly term life is awesome. If you make a lot of money, get it. If you're married to someone that makes a lot of money, you should still consider having robust term coverage. And it's pretty affordable compared to, a physician income. And so it's always worth strongly considering.
Yeah. It's interesting too when you look in the stats of this. I was preparing for the show, and I expected this to be higher for some reason, but now that I think about it, maybe it makes more sense. But 52% of people have life insurance, and permanent life insurance policies made up 61% of that. Now that number is way too high, but 52%, I mean, there's some people that may not feel like they need it. Maybe they can self-insure. Maybe they, have a situation where they are independently wealthy. Maybe they have gotten to financial independence. They no longer need life insurance, which is, by the way, the point at which you drop insurance products is when you are financially independent. You don't need disability insurance, potentially. You don't need term life insurance. So just something to keep in mind. And that's also, by the way, why I think that the average lifespan of a disability insurance policy is like 13 or 14 years, because people after that point get rid of it. And similarly, but for a completely different reason, according to some reports, around 70 to 80% of people surrender, in other words, get rid of their whole life insurance policy. And when you think about that, it's called whole life for a reason. You're supposed to keep it for your whole life. And so, Justin, I think it'll be good to discuss, why do 70 to 80% of people, after they realize what exactly they've purchased and what this thing is, decide to get rid of it? And I think the best way to discuss that is maybe like the good, the bad, and the ugly. It's maybe we'll just combine the good, and the bad and the ugly will be a separate category.
Sure.
But in your experience, and I know in talking with you and in researching for the show, there are some niche situations where whole life insurance, permanent life insurance, is not the worst idea in the world, and maybe actually be a good idea. So where do you want to start with that?
Yeah, let's start about looking at the profile of who should be considering this. And I think the reason that we have to oversimplify in many cases and say whole life insurance is bad, full stop, and it's not quite a full stop. But when you're on a big platform like yours, Jimmy, or if you're doing a lecture for residents or early career attendings, it's not, you got to sort of lie to someone and then you gradually tell them the truth. And nothing is 100% of the time ever, but if somebody in that room is getting sold that thing, it's almost certainly not a good fit. And so that's sort of the lie. I'll put it in air quotes, that it's always bad. The whole truth is that there are a number of unique circumstances in which permanent life insurance coverage can be used for like an advanced planning strategy or in specific family needs, where it's actually a beautiful, elegant solution to a big problem for people. This often is related to estate, business planning, or for people who are very far along the journey of financial independence and are just looking for other tools, options, instruments to enhance their sort of financial circumstances. And it's for that category of people that are pretty far around the track, or, like special needs, estate planning. There's some of those type of niche instances that we'll talk about, those are folks that often will consider life insurance, whole life insurance, and rightfully so, because it can be a great tool to help.
Yeah, and in that context, it's important to remember that the Tax Jobs and Cuts Act that Trump's administration put in place, they took the estate tax limit from 11.2 million to 22.4 million. And so people are probably like, yeah, well, there's no way I'm going to get to $22.4 million with my estate taxes to really make this a product that I would consider. But we have to remember that that Tax Jobs and Cuts Act expires in 2025, and it goes back down to the $11.2 million number. And again, there's going to be a lot of people who are like, I'm not going to get to that number. But there are people listening to this show who are financially minded. You're a super saver. And truth be told, you're probably going to get to that $11.2 million number. And in that situation, all of a sudden, I mean, I'm not going to tell you to go buy it, but it's something that is worth considering, educating yourself about, learning about. And maybe a good point of the show to mention, Justin, because you and I are big on conflicts of interest. Neither you nor I sell whole life insurance. We don't have a dog in the fight on this one. So this is purely financial literacy, purely general education, and hopefully some entertainment purposes too. But yeah, so that number is going to be cut in half again in 2025 unless it gets extended, unless there's something else put in place. So you may be thinking that's not going to apply to me, but maybe it will. What do you think about the idea of someone using whole life insurance? They want to leave something to their heirs, but they're not going to be financially independent, right? Maybe they're on the opposite end of the spectrum. They haven't saved enough, but they want their family to have something when they die, and they recognize they're not going to have much left.
So that's one potential is insurance can be an estate augment. Like now, if you're still in your earning years, like 40s or 50s, and you've still got some runway, you could still use a term policy, because if you got 15 plus years to make money and save money, you can still build a pretty good sized estate, especially if you're a physician. And if you're terminally ill and don't expect to live that long, you can't get insurance anyway. So I would certainly want to look at all options, but estate planning and estate augment, leaving more money to your heirs, or we would call it like leverage. Like you pay a little bit and you get a lot. That's leverage. Through premium dollars, you pay a little bit of premium and you get a big death benefit. Now, obviously, the longer you live, the less leverage you get. But what you hope is that you live a long time. But one planning practice is using this in estate planning through a trust, creating an irrevocable trust. And by the way, good opportunity to pause and say, I'm not an attorney and I'm not your financial advisor. So as we're talking about specific strategies and options and things to think about, definitely work with a qualified advisor and estate attorney and an insurance expert. And maybe this might be 3 different people in order to understand the best strategy for you. But in the estate planning realm, there's this thing known as an ILIT, an irrevocable life insurance trust. That is its own thing. As you know, Jimmy, an irrevocable trust is an entity with its own tax ID, and it is by definition sort of its own taxpayer outside of your estate. So folks who are worried about bumping into the ceiling of the estate limits, whether it's the 25 million or when it gets cut in half or whatever it's going to be in the future. And by the way, it's an interesting exercise to just look at what it has the ceiling been in the past. You can do this with income taxes. You can do this with estate. It's been very, very high in the past for estate taxes. But if you're afraid of bumping into that ceiling, say I've got 10 million bucks and I'm 60 years old, and I'm worried about that ceiling coming down to 10 million and then everything above that being taxed pretty disadvantageously. If I'm willing to give up some control of some amount of my assets, I can fund an irrevocable trust, or I would consider that, get that money out of my estate, have the heirs, the beneficiaries of that trust be, my kids or whoever I ultimately want to receive the assets. And then this can reduce the overall tax burden of this bucket of money. But instead of moving like $5 million of cash, what I may also do or consider is buying a $5 million whole life insurance policy. And then I'm funding it with, it's a big premium payment. It's a 5-figure number per year probably. But this is where the idea of leverage comes in, where I got an extra $5 million bucks. It's out of my estate and I'm funding it with whatever amount of money is needed to get that policy, keep that policy going. And in the process, I'm maintaining control over the lion's share of my 10 million. So strategies like that, again, they're very niche and we're talking about somebody who's already financially independent, but wow, that's actually a really cool tool to reduce the cost of adding meaningfully to your estate and passing more money to your heirs.
Yeah. And that's something that the ILET, Didn't know about. I obviously knew about the irrevocable trust, which, by the way, is such a funny word to say. Irrevocable. I don't know. Maybe we'll put like a little Twitter poll up and ask people which way they pronounce it. But yeah, and so speaking of like estate taxes and super high savers, there are people that save an extravagant amount of money, and this actually is a great segue to some of the bad and the ugly purposes of whole life insurance that are kind of thrown upon people. But if you're maxing out your 401k, you're maxing out your 457, you're maxing out your cash balance plan, your backdoor Roth IRA, whatever things you have available to you, and you're in that situation where like, I really would just like to have more sheltered taxes, then I can see a world in which someone might consider this, because they just are saving so much money and doing so well that this is the only option left available to them, and they are just flush with their brokerage account. I can create space, although I still don't love it. I can create space in my head to see why somebody might, in that situation, consider this as a possibility.
Mm-hmm. Yes. So absolutely. And I think of it like an asset class in those circumstances where, you got your stocks, your bonds, maybe you've got some other real estate, crypto, other alternatives. These are all asset classes. Life insurance can be an asset class, especially if it's owned by a mutual insurance company that's going to have, hopefully, like more financial strength and durability than other companies, we hope and expect. If you can get a whole life policy that has a high guaranteed in air quotes, but a high amount of interest associated with this whole life insurance policy. And frankly, in most cases, that it obviously ebbs and flows with economic cycles, but usually a financially strong life insurance company is going to be paying a rate of interest on a whole life insurance policy above the policy guaranteed minimums. So in the real world, you're going to be doing better than whatever the guaranteed minimum is. And maybe that number is 4%, 5%, 6%, 7%. The real actual sort of earned interest in a policy like this, the rate at which the cash is going to be earning that interest. So that's a nice fixed income proxy, I would call it. It's like a bond. It is very durable. It's going to be growing at this quasi-reliable inflation plus percentage rate. And if I have a bunch of stocks and I have a bunch of bonds and I've got some real estate, having a whole life insurance policy as part of my pie chart is, that can be a really useful thing.
Yeah. What do you think about the situations where, because I have friends that have done this, people buy whole life insurance policies for kids?
Yeah. It's funny. I was talking to somebody just this week who they were really, I knew they were talking to an insurance salesperson who probably didn't have the big picture, because they were scraping by. We were just doing some like initial getting to know you. And they said, yeah, we know we need insurance and we know we should get, policies for our kids. And I was like, tell me more about that. It's like, yeah, the person we're talking to recommended some whole life and I'll be honest, Jimmy, like I've heard of circumstances where kids have gotten those policies and they've been really glad that they have them. And it's been a huge financial boon for someone who like can't get other coverage, or who, whenever they're 20 or 30, they have this thing with some cash value and it's great. But, it's, if you can solve a problem with a simple tool, don't use a more complicated tool that adds to cost and reduces liquidity. If you want to give money to your kids, give money to your kids. You can do it in a brokerage account. You can find a way to get them some earned income and help them fund a Roth IRA. You can do a lot of other things, and that's fully liquid and a lot more friendly. And then if they change their mind about something or something happens, we don't need to get money if a child dies. Hopefully, like, we're making enough that we can afford a funeral. And that's, one of the ways that is positioned. So philosophically, I just don't really see the use for the vast majority of cases.
Yeah, and I think that leads us into the bad and the ugly, right? Because there are some ways in which whole life insurance is pushed on people, and that's one of the ways. Really, for me, most of the time, and I've gotten flack about this, pushback on Twitter for viewing it this way from almost always people that sell whole life insurance, which shouldn't surprise you. They're going to disagree with, anything that doesn't support them making hundreds of thousands of dollars selling a product to people, which they do, by the way. It is an expensive product. And if you don't know this, the typical commission, not always the same. You'd have to talk to your individual insurance agent, who probably won't tell you the number, but it's 50 to 110%. So if you buy a $30,000 annual premium whole life insurance policy, you can expect the insurance agent on average, typically, based on the numbers to earn somewhere between $50,000 and $33,000 based on that one thing. And so I always tell people, if they sell that to 10 to 15 docs, they are now making physician money, right? They gotta fool 10 to 15 people a year if it's inappropriate, which we're going to talk about some of those reasons now. And so for me, the way that I always conceptualize this, and Justin, I'll be curious to see if you see this the same way, is whole life insurance on one side versus buying term and investing the difference between the cost of the whole life policy. So if whole life policy costs 30, your term life policy costs you $5,000 for the year. The question is that $30,000 whole life policy going to perform better for you than $5,000 in term plus $25,000 invested in a account of some kind? And for me, when I run those numbers, almost every time it turns out that the whole life insurance policy doesn't do as well, it doesn't perform as well, and comes with a lot of negative problems, including being negative. It is negative for 8 to 10 years on average. So you're not even going to earn anything, because that's where the commission comes from, by the way. You're going to have 8 to 10 years of negative returns. You're not going to break even on that whole life product. And while this other $25,000 is theoretically growing for those 10 years. And so is that the way that you view this in a educational financial literacy, very high level, non-nuanced standpoint, or do you view it differently?
Anybody who is working with me has the luxury of having an accountability partner, a partner in implementation, somebody who's going to make sure that stuff happens. So if there's $30,000 of free money and there's 25,000 that, is that sort of delta, I'm going to set up a $2,000 a month auto contribution to a taxable investment account, and I'm going to make sure that that happens, and that money is going to get invested every time it hits the account. If you're not working with a professional, you don't have the advantage of the accountability. So yes is the short answer, Jimmy. I think of this exactly the same way you do, and buy term and invest the difference is very effective as part of a cohesive plan where you have the discipline to do that second part, which is the total critical thing of investing the difference. If you don't ever do that, then you could make a pretty strong argument that the in spite of the illiquidity, in spite of the surrender charges that extend for a decade, in spite of all these things, it's actually psychologically helpful in some cases to have that whole life policy if you don't have the discipline. Now, I would say, well, get the discipline, get the plan, and make the better decision. But if you're not going to do those things, then there are some fees that you pay, and there are some, drawbacks in terms of liquidity. But I like to be as open-handed and equitable in these conversations as possible, and that's how I process that.
I think what I'm hearing you say is that a bad investment is better than no investment.
Yeah, if you're going to blow it on a big screen TV or, car payments, then you're better off having a whole life insurance policy, because that's an asset that's going to last. But if you can invest it and allow it to grow and build wealth, then that's superior for sure.
Yeah. And so hopefully if you're listening to the show and you're becoming financially literate, maybe you're already there and, you are starting to understand behavioral finance and psychology of money, you're going to have that discipline to be able to do that. But this leads me into one of the things that makes me genuinely really angry when it comes to this topic, which is one of the reasons that this gets so much negative press, is that I cannot tell you. And in fact, the vast majority of the time that I've seen somebody buy a whole life insurance policy, there are other things that they could have been doing with the money that were not even discussed, because it wasn't viewed as a part of a comprehensive financial plan or discussion. It was simply this is the product, these are the benefits. We're not going to talk about any of the drawbacks. And oh, by the way, I don't know that you're not fully funding your 401k or 403b. You're not maxing out a governmental 457, or your student loan plan is not set in place. And oh, by the way, you don't have disability insurance, which is really far more important than any insurance product for life. And so because of that, I see this happen all the time, where I start talking to friends of mine or colleagues or people that reach out from the Money Meets Medicine audience, and turns out that there are 5 things that they should have done before they even considered the niche, nuanced situation where whole life makes sense. And I'm a betting man. I'm betting, Justin, that you've had the same experience.
Indeed. Yes. And that's always the problem. And that's why we tell people whole life is bad. It's like, it's not actually bad. It's just bad to do it first before these other 6 things that are more important and that are better in most cases. So absolutely. Yes. There's one other important good item that I didn't quite get to that warrants mentioning. And I want to bring it up for business owners. There's a lot of different, when you're a business owner, there's a lot of insurance considerations that are totally separate from the personal side of things and that are very important. One of the things that business owners think about is what we'd call key man insurance, or often like a buy-sell type of arrangement where, if there's 2 partners in a business and one is like the technical head and the other is like the a business development person brings in business, or if it's two partner physicians, you've got a certain number of patients that you're serving, and then one of the physicians dies. There's a number of problems that creates. One is the value of the equity. So if it's a practice that's cash strapped, that physician who passes away has a family, spouse and kids. How are we going to give the spouse and kids the economic value of the stake in the medical practice if we're just barely paying the bills and barely paying payroll? That might be millions of dollars. And so in this case, now you can do it with term coverage, but this is also a case in which sometimes it makes sense to consider whole life as part of we would call that a key man. Another would be like a buy sell, where we would have and again, this is pretty technical, so work with a lawyer and your CPA on this, but having the partner, your other partners, be beneficiaries of the policy so that they can pay the spouse the predetermined value. Now, this is imperfect because obviously if you get $1 million whole life policy, the value of the practice or what the spouse hopes to get might be $3 million, or it might be less than that. But it at least creates a mechanism for some protection, for liquidity, to be able to buy out the equity of the deceased owner. So that's a really important part of protection. And sometimes, in some cases, it makes sense to have this be an asset of the business, and it does, have value in that way. And so in terms of business succession, buy-sell arrangements, protecting the surviving family of one of your business partners or your own family, that's a really important use case, and it definitely warrants mentioning for any practice owners out there.
Yeah. And so hopefully you're listening to the show and you realize that there are some very niche opportunities for whole life to be a useful part of your financial plan, whether that's the estate tax issue, whether that's owning a business with a partner and dealing with the consequences of that. Maybe you're a super high saver, maybe you're not going to have enough, and whole life's the one way you can leave money to your heirs. That said, there are reasons why it gets lots of bad press. The majority of people, in my experience, are not going to run into those problems. There are people that are, and those people should consider whole life. But 80% surrender it. And there's a reason why. They learn about it. They finally see the surrender charges. They see the cash value. They recognize that I'm paying into this product that isn't going to accomplish as much as something else. So, Justin, there are people that come to you and come to me and say, hey, I've got this whole life insurance policy. What do I do? Do I sell the policy? Do I surrender to get the cash value? Do I roll it into another product like an annuity, or, God forbid, another whole life policy? That doesn't make sense to me. But that is an option technically. Like from a general education level, I know, because you can't go into, obviously specifics, because it depends on the illustration. It depends on the cash value that's in the policy, how long they've had it. Maybe sometimes it's worth keeping it. Where do you start that conversation just so people can start thinking about it?
The thing that you need is an in-force illustration. That's the technical name for it. That's basically describes, here's how the policy is currently functioning, and here's how it looks based on, the certain assumptions that are built in to the policy. It also makes sense to see that illustration at sort of the guaranteed return levels. So there's, and this gets very complicated very quickly, and definitely it makes sense to work with an advisor to answer these questions. But a couple of things I would want to understand are, what are the guaranteed rates of return? What does the sort of baseline in-force illustration look like? And what are the key assumptions? Meaning, what is the credited rate of interest on this policy? Where is it now? Where did it start? What is the lowest it could possibly go? Understanding those things. And then the term of surrender. So how long am I going to have to, get dinged before this policy is finally free and clear, and then I can cash out of it without paying a surrender charge? That's a useful thing to know if you're going to redeploy it into a different investment, a different insurance policy. Making sure that you understand that the surrender term, that's important. And then it does often make sense if you have a very laden with fees type of policy. Often it makes sense to consider other less fee laden policies and do an exchange that will, keep the tax implications to a minimum rather than cashing the thing out. And if there are gains, then you're going to be taxed disadvantageously. So it really is, if you've been bitten by the snake and you're wondering, how do I fix this? It's not the answer is not necessarily straightforward, but you got to start with the illustrations, think about your circumstances, look at a cash out, look at an exchange, and look at maybe just tweaking the terms of your existing policy to make it, maybe you can have the flexibility to drop some riders or change some things to make it do a little bit more what you want it to do. And that may be a solution that makes the most sense in your case as well.
Yeah, I like the first step of getting the enforced illustration to make educated decisions about it. And hopefully this show, one of the things I love about this show, Justin, is that we don't live in the echo chamber. We have our own views and nuance on subjects that oftentimes get the same exact story told over and over and over again. And so whether that's our focus on behavioral finance and psychology of money, or taking a different view on financial products that universally get bad press. And to be clear, the vast majority of the time, it is very well deserved when it comes to whole life insurance, that bad press. For the vast majority of people, in my experience, this is still not a product you should consider. That said, there is nuance, there is gray, there is an educational component to this that you need to consider. If you have a policy, seek out an advisor, show them the enforced illustration, work with someone like Justin to help you sort through that process and determine what the best steps forward are for you. And if you have questions, you can always reach out to us. Jimmy at moneymeetsmedicine.com. I'll forward it along to Justin if you want him to tag in. Or Justin, what's your email address you can share with people?
Yeah, you can email me at justin@apm-wealth.com.
There you go. All right, everybody. We will see you next week. Don't forget, you can snag a free copy of the Physician Philosopher's Guide to Personal Finance on moneymeetsmedicine.com. Share that with your trainees, with other friends, colleagues, and share this show. We appreciate you growing the audience so that we can help more people learn about money and how it interacts with medicine. We'll see you next week. Cheers. Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.